Hi, Bernhard. How are you?
Hi, Alex. I'm great. How are you yourself?
Good, good. Every 2 weeks, we catch up to talk about interesting stuff in the insurance world. But before we jump into the insurance, I wanted to share a fun story. So every year for the last 7 years, in October, I've been running Risk Awareness Week, which is a 5-day virtual event, 3,000 to 5,000 people from 140 countries. This year, me and you are doing a full, like 3-4 hour training on insurance buying, or rather I should sell risk selling. I think because that's the concept that we're trying to bring to the insurance managers and the risk managers in asset heavy companies. But you know, as I kind of prepare and start brainstorming for what we want to talk about and how do we showcase the methodology that saves my companies a lot of money, but also how do we show people that ScyAI can now do what used to be months, now you can do in, you know, hours and days. So as I'm preparing for that, I'm having fun a lot with different event professionals as well as AI models. And one of the cool ideas that I've tested this week was I've created a multi-agent which researches your company, identifies the most significant risks, documents the risks in the format that would be acceptable to a typical regulator, which, I mean, sounds exciting, but it's not, because the bar is pretty low. The regulators really don't expect much. And then drafts a board paper, like a memo on presenting these variations, and it ranks the risks and, you know, writes the mitigations. And then it also does like a little cross check against the 2 risk management standards, ISO 31000 and COSA ERM. So it kind of does all of that. And I've tested it obviously on my company, and I've tested it on like companies that I know well, and it's not bad. Like it's a really good package, and your single, well, actually not, sorry, you're not your single input. Your first input is the company name and the country, so it can kind of find the right company to research. And then it asks a few follow-up questions like, what are your strategies? What are your priorities? What are, you know, have you had any big incidents recently? So it asks some follow-up questions, and then it just gives you these deliverables. And I made it available for free.
Went pretty viral on LinkedIn, huh? I saw like it went pretty viral.
It did. Yeah. As of today, I think it has like 33,000 reach, which is, you know, which is like a good, decent post. Since I'm paying, you know, behind the scenes, I made it available for free, but I'm paying for the tokens behind the scenes, and I can see like how much I'm paying for this, and it spent 9 million tokens so far.
Oh wow, that's a lot. That's quite significant.
Yeah. A lot of people used it, and okay, it's like, it's, you know, it's not an outrageous cost, so it's all part of my, you know, fun experiment. I like paying for things that make me laugh.
And I mean, people
right,
love it, right? Like, I guess like people love it, right? Because it went viral, right? But then also like, I think I had like a look, I clicked through it and I think I put ABB in just like to check it out and stuff like that. It's super interesting, but also what we see there, hey, there is like this demand from people, hey, they just like want to figure this out. They want to play around with these tools. And also like in the training that we're going to have done, risk awareness week, right? I think it's going to be interesting to show way beyond like what are the magic moments that we create, right? Beyond that, because if they're already getting excited by that, like I mean, we're going to have like a blast then at the risk awareness week, because there it's going to be like 10x.
Yeah, well, and that's exactly the point, and why I'm telling all of this long story is that, spoiler alert, if you haven't used the tool, you should. It's in the URL is rm1, which is for my risk management one, rm1.riskacademy AI, and try it. But spoiler alert, if you haven't used it yet, switch off the sound. When you do use it, it generates all of these deliverables, and there's a clock in the corner, and it actually, on average, it takes about between 1.5 minutes to 3 minutes to generate what used to take consultants and risk managers probably weeks or months to generate. And the quality is decent. I've limited it to like, I don't know, like 15 risks. You could have easily made it, 40, like it. The principle, once you figure out the principles, you can expand or contract it like in any shape. But the point of this whole exercise, and this is the spoiler alert, is that when it finished generating, it shows the big clock, and then it shows the compute cost. And it says it just took AI 1.5 minutes, and it cost 20 cents. This is how much your job is worth if that's the only thing you're doing. So if you want to, command a higher salary, if you want to be, valuable to the company, and if you want to justify the value of your team, you have to do something different, because that version of risk management has been commoditized. I can now generate like full risk management deliverables in minutes or cents. And it literally goes, if you're doing this, you're competing with machines. If you want to compete for like higher price and respect, you have to do something completely different. And this is what Risk Awareness Week is all about. Come and join us at the Risk Awareness Week, and we'll actually show you what good risk management and looks like, that you can't replicate with just a generic LLM. You either have to spend, and we've now spent, I think, well, maybe just under a year of building the actual ScyAI engine. So it's, it's a very far from a generic LLM. The way we trained it, the way we evaluated it, the way we set the guidelines and the right sources, the way we grounded and created ScyAI is is a completely different animal to your generic LLM. But to me, this is just an amazing, very intuitive experiment of showing that it literally takes minutes to generate something not particularly valuable, but looks colorful and good, and it generates like all the typical risk documentation that you would expect. But that's just not good enough. You need something so much more useful to actually make money and save money, because this this commoditized risk management is not going to save money to anybody anymore. So you can't like, if you are a risk manager or an insurance manager, if you are unsure about the value that your function delivers, you have to do a lot more. And it's either months and months of manual work to integrate into decisions, to properly contextualize and quantify the risks if you're renewing the insurance, or you do have to use specialized agents that have been built over years to do that specific, very niche, very specific task. Because we are close to spending a year on ScyAI, and it's only focusing on one insurance type, which is property damage and business interruption. Not even all the different insurances. So then there will be, obviously once we scale, kind of I think it will become exponential for the other insurance types. It will not take another year for constructional risk, and it will not take it will take less than a year for liability insurance, because the harness, the digital twin will already be built, and it's a matter of reusing it for the different application. But yeah, so I just thought that was amazing, and I'm fun when it went viral.
It just like it naturally scales them very easily, like horizontally, right? What you mentioned, like beyond PBI and stuff like that, right? And I think like what you just like outlined, Alex, hits the nail really on the head, right? Like what we're thinking about, like, hey, on the one hand side, you commoditize all this work, right? So you guys, like the insurance risk managers, have to move up a level up of abstraction, like where you now have free time to focus on the valuable stuff. Like you have to focus on the value level stuff. But then you're going to run on maybe into other issues, right? Like the first thing probably that people, when they're listening to us here, like going to say like, would be, yeah, okay, but the AI hallucinates, right? Or AI, like I cannot trust these outputs now, right? Even though if you do like this amazing assessment now, right? Like I cannot trust it. These are all problems that we already figured out, and that we figured out now through like working on Sci, making it trustworthy, building a trust architecture into it. And these hallucinations are like also like not a part of it anymore. And now you build up this trust architecture, and you step by step level up like your game. And then we're gonna have like an amazing fun at a risk awareness week, just like pushing the limits of what's possible. And I think that's the exciting parts there, like just like really building here on the frontier and pushing what's possible.
Exactly. So you've had a fun few weeks. You've been speaking to risk managers, insurance managers, underwriters on both sides of the risk selling transaction, risk buying transaction. What are some of the surprises? What are some of the interesting things you've heard in the market?
Where to start? Like I would like to just like share some stories or quick insights from the underwriting community, right? Like as you know, like I have a lot of friends and former colleagues that work at Swiss Re's, Score, Munich Re, etc. And when I talk to the global underwriting elites, right, or the heads of underwriting, it's super interesting to hear the other side of the coin, right? What they struggle with, right? And what I hear from them is like, hey, yeah, like the submissions that we get, etc. It's a huge struggle, bottleneck to actually validate the results, right? Like the information that we get, like, is unstructured, and then it's hard to validate actually, hey, is this stuff true? But then also like, hey, like we run like then these roadshows, and only 5% of clients actually send us the submission before the roadshow, right? Which I just like thought that it's insane, because why you have then what are you going to talk about like in the roadshow, right? And stuff like that. So I think that was the second thing. And then the third piece around the underwriting community that was super interesting, just like their appetite for actually, hey, we want to have like more data. We want to have like more context on the risk quality and stuff like that. It's just like we struggle to get it in the right format, right? And we struggle to validate it directly. So they are open to it, right? They're open to actually apply additional modifiers, look at the risk like in a more bespoke way. They're just like right now the market doesn't serve them the information in the right way.
So and that, I mean, that's like three massive points. I mean, the first one, when you mentioned this to me, I couldn't believe it, because it doesn't fit in my frame of world. So it just like, it makes no sense. Apparently, for some of the large underwriters, what they experience is that companies either rely on questionnaires instead of like a detailed submission document. But even with that, they usually do the roadshow first to kind of, meet and greet. And then they send the submission / questionnaire later, which to this day, I don't understand. Like, I just don't understand how that could make any kind of logical sense for the relationship, because the whole goal of Roadshow / submission is for the risk owner, for the company, to explain, to communicate, to convey the risk to the underwriter, so the underwriter can appropriately price it.
But let me chip in here, just
yeah.
like, because I think that's super interesting. Like here, if I play devil's advocate, I would say like, okay, a lot of people think like, no, but if I do not send the submission directly before, like I'm not gonna have uncomfortable questions during like this one-on-one time, right? But that's exactly what we want. Like if you cannot address like any uncomfortable questions, like and move that away, do you think they're gonna price you better just like because they did not have the chance to ask the question around it? No, they're gonna price the ambiguity.
And I mean, this is like, it always surprises me, because I guess once you kind of live through it and see you've done the kind of the A/B test, and you know that the other way is always worse. You don't like it. It's counterintuitive. You don't realize that, but in reality, if you didn't mention something, the underwriter still has to fill it in the model, in the pricing model. So they will have to make an assumption. And what are the chances that they'll make a favorable assumption for you? It's highly unlikely. So because underwriters by default are quite conservative, and my favorite underwriter keeps telling me, like, every single phone call we have, he goes like, yes, but I am very conservative. I'm like, I get it. Okay, I got it the first time. They always will choose a more conservative option for whatever you haven't mentioned to them. So basically, silence is costing companies a lot of money, because they actually just don't know what is being priced. I've had another underwriter during the roadshow, after we've sent them, like, I don't know, like a 20-page submission with details, after we had numerous Q&A rounds via email, they've asked us if we do underground mining. And I'm going like, oh my God, ionic clay, rare earth is like literally the opposite of underground mining. Like, it couldn't further from underground mining. And I'm going like, really? Like, this far into conversation, the fundamental risk, modifier is still somehow ambiguous. But that was, I mean, so this is to me is an absolutely crazy assumption. I mean, it's crazy from a risk management point of view. It's like, it's not actually that crazy from a human behavior point of view, where you choose your individual comfort of not having to answer difficult questions and not having to convince. Because, like, for example, we are all human. I dislike that part of the job as well. Like, I have to invite our head of operations, head of engineering, head of safety, head of environmental to the call. And I had a weird roadshow not so long ago, where I've invited all of these, senior engineers from different parts of the business, and had, head of finance as well, even though it was like a liability insurance, procurement team, and underwriters did not ask like single technical question. So I had, these like 5 executives sit for, half an hour on the call, not really needing to answer anything. So, it always happens, and it's uncomfortable. I get it. But to choose your personal comfort over, this, half an hour of wasted time, that's just weird to me, because the more I'm the opposite. I get really upset at the broker or at the lead underwriter, whoever sets up the call. I get really upset if I don't get any tough questions, because there's no way they understood the risk from just the submission. Because again,
they did not, right? Like, but if I chip in here, right? Like, also what I heard there from the different discussions, right? I think it's this interesting social kind of how do you say it? Like the momentum in the call, like in a way, like like you, for example, you want like the underwriter to ask you the right question, the challenging questions, but then the underwriter does not want to piss up the broker of being too negative or whatsoever. So the underwriter still gets looped in the future by the broker. So we need like this one kind of platform, or I don't know, interaction API like interface, where just like we can have like these open questions, right? Where we can do discuss that. And right now, with what we have, we just like have to nudge these conversations in the right direction. I think you're doing that, but it's very uncomfortable, as you mentioned, right?
Yeah. But well, exactly. And this is another great point that you bring up, because like that would make me super upset if the broker was somehow smoothing out the questions and not allowing the underwriters to ask the most challenging, most critical questions to me. So I'm not even aware that's on their mind, because regardless of whether they ask the question or not, they're going to price it.
Yes,
like
exactly.
that's a given, and I want to know what they're pricing. I don't want to be surprised at the price stage. I want to be surprised at the roadshow stage, because that's exactly what the roadshow is about. It's raising all of these questions that and misconceptions that people may have in their mind. And so yeah, I would actually freak out. I mean, I did 5 years or so. I did a roadshow where I had brokers, 3 different brokers, invite like a dozen, if not more, underwriters, and then the brokers were not allowed to join the call themselves. So no broker. It was a roadshow with no brokers, but just the underwriters. I mean, I can't say that it like magically improved the quality of the conversation, but also I want like all the different. I've divided the markets. I've used simultaneously different brokers for different markets, and I just didn't want the hassle of like different brokers trying to show how clever they are on the call.
And then I just like to chip that in, right? Like to simplify the overall thing, right? I think what we're also talking about here, right, is like this expectation management. It's kind of twofold. It's 2 things. Hey, do you guys want to use like this over the roadshow, etc., just 100% for relationship building because you think you're gonna get based on a relationship the best or better price? This is like kind of the one extreme, and then the other one is like, hey, no, we want to use like this time to really get rid of any ambiguities, really have like a great conversation about risk quality, etc., that we both parties or three parties can make the right informed decisions on this deal, right, that we have. Like, and it kind of these 2 different things. And for us, like the first piece that I mentioned, right, where it's just like relationship, small piece of that is obviously also there, right, like to have long-term collaboration, stuff like that. But for us, we want to work with the people that really want to do like a fair, good deal on that, right? It cannot be that it's just like about the dinner, that it's just like about the relationship here. This is straight business where we can actually quantify risk, and where we all have like a responsibility to our stakeholders, etc., to our companies, right, to really make there like a win-win situation. And that only works when we're transparent.
And well, I'd go one step further. I've had 2 or 3 examples where I had to step into somebody's kind of insurance portfolio. So there was an insurance manager, and he was different insurance managers. So 3 different scenarios, 3 different insurance managers, and each time they were adamant that they had an amazing relationship with the brokers, with the underwriter, whatever the underwriter was at the time. Amazing relationship, dinners, birthday cards, you name it. Fishing trips, probably. I mean, although I can't actually justifiably say that they didn't have fishing trips. Like somebody somewhere definitely had it in my story. But the point was that 3 times, different countries, this premise that relationships are important, I've smashed them on the rates by like a mile. 3 times lower rates, 4 times lower rates, 2 times lower rates, huge savings on an improved quality of risk. So more limit, better deductibles, better coverage, so less exclusions, better wording, and still lower price. So in my view of the world, this whole debate between we use the roadshow as building the relationships versus we use the roadshow to transparently share the actual data necessary for the underwriting. In my experience, like, that's not even a debate. There's a very clear winner every single time, and I mean that truly amazes me. I think it's a
But
wasted
and
opportunity.
And I agree, but I want to add some nuance because I still think that you are building relationships, but you're building them in a way like on a shared understanding, hey, that we are going to like work towards getting a mutual understanding of the risk, etc., and then make a good deal. For me, this is still like relationship building. It's just like on the right premise, right? It's on the right premise.
Thank you for reminding me this, because that's the point I was trying to make, and then I forgot it halfway through. Because what I'm looking for in the insurance counterparty is somebody who appreciates the quality of our risk, rather than somebody who appreciates hanging out and dinners and events.
Yeah.
And so it is indeed a relationship building, but it has like a different criteria for what is success. And essentially, like that's the point I think we're trying to make, is the world is a pretty big place, and there's the broker and there's an underwriter for everybody.
Lots of
And it's
fish in
just
the
a
sea,
matter.
a typical one.
Yeah, well, yeah, that's exactly the point I'm trying to make, is that it's a matter of packaging your risk in a transparent and comprehensive way, and then just going around and trying to find someone who will appreciate your risk, who wants
Yeah.
your risk today. Because maybe some company is already overly exposed to Brazil and they don't want any more Brazil. Maybe another company doesn't understand, I don't know, like shallow mining, and they don't want to understand that. But there will be somebody who wants it, who is capable of understanding it, who has the relevant engineering expertise. It's essentially like matchmaking exercise. You have to present your risk in as detailed and as comprehensive way possible, and then you kind of walk around and you go like you go like, here's my risk, do you want it? Do you want to maybe take 10%? And then they go, oh, 10% is the maximum we can take of your risk, but we are risk based. And we're going like, no, you're not. If you can't take more than 10% of the risk, that means you are the opposite of risk based. You are risk averse. But anyway, that's the you understand the point I'm trying to make, is that it's literally
Yeah,
just
100%.
matching your risk to somebody's appetite for the industry, the country, the control maturity, the engineering maturity, and so on.
Yeah, and then you have to understand. We have to understand like the other part too, right? The capacity seller side, right? Like they're not gonna just like change like the overall underwriting strategy, etc., because you had like a great dinner and stuff like that. They want like to find the right winners, like that have the right risk quality, or that actually just like have the right risk that they want to invest in, right?
Yeah, and yeah, it's spending the time to understand the other side, the underwriting strategy, is also super important. And I know I've told you this story a while ago, but it was ages. So I think it's worth repeating because it's fun. I remember one of the companies I went to, like a one-day event for the clients of this big insurance company, and one of the underwriters was presenting that they've just opened like a new product line for green technologies. And and they, basically started listing like the wind farms and the sun. God, what are they called? Panels, solar panels.
Solar panels, yeah.
Yeah, and like few other products that are very close to kind of energy transition and green energy, and so I go. But hold on a second. Rare earth elements are fundamental to magnets, and magnets are fundamental to wind turbines. We're 2 steps away. Well, okay, 3 steps away from the actual, green technology. I'm like, shouldn't we be called green as well? Because and I can't remember the exact number, but I think it's 60, 70, maybe 80% of demand is all green. It's either electric cars or wind turbines. So it's a huge component. I mean, I consider ourselves a contributor to the energy transition and to the green economy. So I went going like, we want, to use this product, and somebody like whispered in my ear, goes, you don't want that. Like they apply a different underwriting methodology, and the pricing is significantly different from a like traditional mining, because they understand mining a lot better, and there's less premium, kind of risk premium in the methodology for like plain vanilla mining than for green projects. So I thought, well, that's a useful piece of information, because I almost signed up for something that would have just made it more expensive, because I didn't understand how they actually priced it.
Yeah, exactly. And this is the fun part. Like, it's a super good example for that piece, right? And just like, I have like a fun story there to also tell, right? Like on the reinsurance side, on the corporate insurance side, what we tried to do is like, can you map like ESG, so in general sustainability, etc., and ESG scores to claims? Like, is a company that has like very high ESG scores more likely to have like less claims? Is this better risk? So could you do like a green premium, for example, on
I would love to know the answer to that, by the way.
Oh yeah, it was complete bullshit. It didn't work. No, not even for
Yeah.
DNO. I
I'm
think maybe for DNO
at all.
for DNO, the only thing that would have worked, like you do not want to underwrite the absolute laggards, right? With regards to ESG scoring and stuff like that, which kind of makes sense, right? You somehow have to end up like with a super bad ESG scoring. But in the end, like there is just like not enough signal in these bullshit scores. And we literally looked at like again, like global portfolio of a reinsurance company across all the claims, and there was nothing in there. And that was still during the time where all the insurers wanted to provide like green premium on like the overall, like when I say green premium, I mean like giving you a discount on your premium because you are more green. And it just didn't work out. And nobody's gonna pay you nowadays anymore green premium. That's anyway over. And they always are going to, in the end, like it's about the risk. It's in the end, like it's not like thinking about, hey, is this like something that qualitatively like we think is nicer and good, etc. No, end of day, like the capacity and prices, etc. have to be sound, and there is no freebies.
Yeah, well, exactly. And the better you understand your own risk, the better you explain that risk to somebody else. The more fair, and I think this is the idea that some people that talk to me and I share our experience with kind of struggle to understand. It's not really about lower premiums. It's about a fair premium.
Yeah.
It just happens that the conservatism of underwriters is so significant that every time we understood our risk and we started looking for a fair premium, that fair premium just happened to be significantly lower. Like not once. I've had an increase in premium because we disclosed something, and like right now our plant in Brazil is like brand new, so there are issues that are understood, controlled, and there's a good de-risking program. There's significant capex invested. Like okay, that's a that maybe is an easy asset to insure because people want it. I've used to insure like 50-year-old mines in Siberia, and it still applied. Like we were still able to find savings even on the asset that I've been to, and I've seen that it's okay. It's not amazing quality, and there are significant investments that they still need to do. But even that, when we explained and showed that to the underwriters, it still was better than whatever they were pricing the previous year. So like regardless of how good or bad the condition of your risk quality, the underwriters always think it's so much worse. And
Exactly, and that makes me like, hey, should I cry about that now, or should I get massively excited? I get massively excited because there is so much problems to solve here for the overall, for globally, right? Like we can just like create so much value and actually make it more resilient and get like the fair price, like the adequate price for this resilience. And just like, this is like music in my ears when I listen to you around that stuff.
Yeah, well, yeah, exactly, indeed. And I mean, this is it's interesting because I think parts of health insurance, parts of car insurance, some consumer housing, real estate insurance, they've kind of went through all of these cycles and they became commoditized. So there's now lots of competition, generally kind of decent understanding of the risks, and the margins are not huge, and so there's like a predictable fair price. That is not the case at all with property business interruption, construction all risk, and product liabilities and general liabilities, and few other corporate insurances. Marine cargo is probably like the closest to being commoditized, just because they have a lot of like data points and they can actually estimate what is the fair cost on different vessel types, on different routes, and different ports, and so on.
And even there is a lot of improvement potential.
Yeah.
I told you, right, like what we did in automotive with the global movement of actually premium cars and how you can improve the overall insurance program on this, which also ScyAI is going to be able to do. So it's even there. So yeah, like even excited around the marine logistics piece.
Exactly. So imagine the kind of, it's all about this information asymmetry. Because there is such a difference between what the company knows and what the underwriter knows, and then the underwriter somehow has to balance out this lack of knowledge. They significantly misprice the risk, and then that means anybody who is willing to invest a lot of time, like we did, many years ago, or use something like ScyAI to kind of to speed up this transparency and really create a layer where the risks and the controls and the exposures are documented in the digital twin that can be explained and showed and justified to the underwriters. They the benefits, the value is just sitting there for the taking. And in the beginning, in the very beginning, you've mentioned another point through your conversations is about information being verifiable, and I think again that's a challenge you'd struggle to prove in the traditional questionnaire. But with the digital twin that kind of maps every number to the source and unpacks it and then references where the data came from and how it correlates to other sources, I mean, that is another huge challenge, I think, that digital twins are solving.
And which is a fun problem to solve, right? Like just like a very simple example, like roof, right? What kind of roof do you have? How much square meters or whatsoever has like a facility, warehouse, whatsoever? Like you literally, ScyAI checks it. It looks at the satellite image. It can create a twin on that front, right? And can share it with the underwriter. what other proof do you need, like than the satellite image and these other things, like with sound methodology, right? There we can then further progress and actually provide the evidence, and it's objectively true then, huh? Like you cannot just like say that I know, okay, the satellite image like that and that stuff is wrong, because the underwriters like and the insurance companies, they use like similar stuff, right, to validate it, but maybe they don't have it yet, or like you want to. Maybe only like 20% of them have these capabilities, right? And we expanded them, like now everybody can bid on that because we provide it through the tech stack that we have.
I mean, that's actually a really good point, because in the past, you would submit the questionnaire with maybe some attachments and some documents from the company. But now, I think the power of digital twins is that you can contextualize the facts with externally verifiable independent data, either through imagery or data pulled in based on the locations, or any other sources that kind of provide the relevant context for the risk. I mean, we live in an amazing world.
It's fun times, yeah. No, it's very exciting to work on that. And I come from the insurance industry, building like a lot of the CAT models and stuff, and just like working across all of these risks. So, but this is like the most excited I've ever been over the last 15 years.
Well, yeah, exactly. And I was rereading some of the transcripts of our earlier conversations today, and one of the points we were talking about is that it's not really who has the biggest model, because most underwriters, especially at the reinsurance level, have like probably close to state-of-the-art models. Like, even though, hand on heart, their model's actually not that amazing, but it's still better than the other models that are floating out there. So it's not really about having a bigger model than the underwriter. That's not what we're really talking about. We're not really talking about out modeling the underwriters. I think what we're talking about is finding the right inputs, checking the assumptions, providing the right data points that the underwriters themselves can model that correctly, because the algorithm may be amazing, but if the insurance managers, and again, this is so much more common than I expected. If the insurance manager is lazy enough to not even get the right geolocation for the actual warehouse or the actual plant, and the location is 100 meters to the side, or 500 meters to the side. I mean, I was surprised when I started mapping our location. It actually took me and Julian a good half an hour to find the actual plant, because there's an office in one part, there's another office in another village. There are few stations, water pumping stations along the way, and they all have different locations. The substation is in the third place. Taking the time to get the kind of accurate inputs and assumptions into the underwriter models, that actually makes a huge difference.
Exactly. And I love to talk about it like that. Like, there's this typical problem where people think, hey, the problem is actually the exposure. To model where the hurricane is going to hit, where you're going to have the flood, where you're going to have the earthquake and stuff like that, right? People constantly think and over focus on, hey, I have to be able to completely understand when is the tornado going to be, where is going to be the wildfire and stuff like that. But that thing is heavily commoditized or commoditizing, but actually I would say it is already commoditized, that piece. The hard piece is not the exposure piece, it's the vulnerability part, the what is actually standing at a certain location where I already have the understanding of what the exposure is. I know how often you have hurricanes in Miami, what the wind speeds you're gonna have there. But understanding the vulnerability, understanding the piece, what do you have there, and having a full understanding actually, where is your crucial substation, for example, or a generator, right? Is it here, like in the right place, or is it 100 meters further down the line where there's a flat zone and you're communicating that your super vital generator is actually in a flat zone to the underwriter? It's gonna have like obviously an effect on your price. So there's these different pieces now where on the one hand side the exposure part is commoditizing, also like all of these different solutions guys that you buy that claim themselves like, hey, we are a climate solution and we quantify your climate risk. All of these are wrappers of the ICCP6 models, which are open source, etc., and which are nearly 10 years old now, right? So all of this stuff is commoditizing, especially with AI. So what you need is like the right contextualization layer and a digital twin that you then actually can benefit from this commoditization and actually have access to all of these model outputs. So now I made my speech on that, but I think that's just like, it was super important.
Yeah. I agree. And I mean, this is, we've had this conversation before, but like, this is what I am discovering, because my first ever renewal was marine cargo fertilizers, 3 billion turnover on CIF between Europe and Latin America. And I went like all out, build a model which it was so silly. It wasn't just modeling the losses, like the loss exceedance curve for the overall policy. It attempted to model separately warehouse theft and damage, separately ports, separately trucks, separately river barges, and separately sea voyage. And then I was like, thinking of, well, how do I aggregate it into like a consolidated model, only to discover that precision of modeling doesn't shift the kind of the pricing that much. And other things, the contextualizing of the actual risk, the controls we have around warehouses, how we select warehouses, how we due diligence warehouses, how we monitor the state of the warehouses, the types of ships that we use, and the age of the ships, obviously, the different product characteristics that we move, that the fact that only one of our 8 products was corrosive and potentially flammable, and the controls around it, that flammable product, all of that contextualizing made so much more difference to the actual underwriting decisions and pricing of the risk. So yeah, I mean, it's a weird situation, which I never thought I would say. I think the modeling kind of has been commoditized. It's the understanding and the context around the models and the implications and the quality of the risk and the quality of the controls, most importantly, the quality of the actual mitigations, that really shapes the kind of the pricing model.
And building this trust on your own data, right? That's what we also see now, like with people that use the platform and stuff. We have to have like this evidence also for ourselves, trusting what is in there in the digital twin, so that we can work on top of that. Otherwise, like, it's going to be a challenge. You're not going to fully trust the outputs, and that's like the other foundation, right? That we have to have in place to actually make that work. Yeah,
exactly. And I mean, I like it because I remember it was such a weird conversation. I remember sending an email to our financial controller in Brazil, going like, "Can you please ask for photographs of our like 3 biggest warehouses?" Because I really need the underwriters to see the warehouses, to feel confident in the level of controls they have, the flood protection, the fire protection, the security. I just need to see the security around the warehouse. Because if somebody is going to be concerned about theft, I need to dismiss that risk up front.
Exactly.
And I can't just promise that it's going to be fine. Like, I have to really show them visually that it's going to be fine.
And what doesn't go away, right, is a judgment call in the end. even like with the biggest and the most amazing data available, like we still have like a judgment call. Initially, now obviously it's a human judgment call. At some point, it's going to be an AI judgment call with human in the loop, but it's judgment. So like what you just like described there, but still humans. We want to see it. We want to grasp it.
Yeah, exactly. And I mean, maybe one day we will have AI underwriting, and digital twins, I think, will come in super useful when that age comes, because the digital twin can already, unlike a human, I like what you said recently, or was it, maybe it's in one of the transcripts, because I've just reread the conversations, and it feels like you said it recently, but maybe it was like 6 months that we did a webcast. You said that we really need kind of submissions in 2 languages. There's like a short summary for the human to read, and then there has to be like this machine readable attachment that actually translates the risk into the language that AI can understand and price.
Exactly. We're building kind of in this dichotomy, if you can call it like that, where one is like, hey, we have like certain outputs now that are focused on humans for them to make to have the right context to make a call. And then we have the other data or other kind of outputs, which should be focused fully on agents, on AI, etc. Somewhere they meet, yes, but in the end, like it's kind of these 2 different versions. And we built for this future, right? This is the future. Like we're not gonna rationalize away like the human. It's just like that we're all gonna get like massive leverage, and it's gonna be a super fun future where we not just like put stuff into Excels, etc., and crunch the numbers there. No, but because we want to all be like the Tony Stark who has like done the strategic oversight and can vibe code like the best insurance program that is like the most robust it has ever been and the most resilient it has ever been.
Yeah. Exactly. Well, thank you. I think this was a fun chat. I'll
Likewise,
see
yeah.
you
Thank you, Alex.
in 2 weeks.
Exactly. Lovely. Have a good one.